Disney and Netflix are two very interesting entertainment companies, and investors are asking which one is the better growth stock to buy today for the long term. I'll answer that question by comparing the two on revenue growth, operating profit margin, cash flow from operations, and returns on invested capital. Finally, I'll compare the two on valuation, measuring them by the forward price to earnings ratio and comparing my discounted cash flow valuations for Netflix and the Walt Disney Company. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I pulled up a chart for the previous 5 years of revenue growth between Netflix and the Walt Disney Company, and we see an interesting development here, with revenue growth accelerating for both Disney and Netflix. The streaming industry, especially, has been very attractive to me. The way the streaming industry, the way the leader Netflix responded to increasing competition by rivals, I really like that leadership by Netflix. And what I mean by that is in 2019, when Disney announced it was coming into the streaming industry, and then, of course, in 2020, when everyone and their cousin wanted to be in the streaming industry because of the pandemic and the amount of time people were spending at home. Netflix wasn't threatened by the increasing competition. They were confident in their customer value proposition. They didn't panic. They didn't lower prices to retaliate, to try and retain their customers. They said, we like what we offer customers and we think customers like what we have to offer. We'll actually increase prices and not decrease prices. And so the competition said, Netflix, we like the way you're reacting to the changing industry dynamics. We will also raise prices. And so the whole industry decided to take on these price increases. And so Netflix has been increasing prices by several times, by several dollars per month over the last 5 years. Disney has been increasing prices. Paramount, Peacock, Amazon, all of the major streaming providers have increased prices over the last 5 years multiple times. And that's led to a very favorable industry dynamic. I love to see that when I'm investing in companies in an industry, that type of competition is very attractive. It's the opposite of what's happening in the electric vehicle industry. Tesla felt extremely threatened by the increasing competition from rivals coming into the industry. Similar factors, right? In 2020, everyone and their cousin wanted to have electric vehicles. And what they did instead of what the streaming industry did is say, we're going to slash prices. And so what did the competition do? They responded by slashing their prices. And so everybody has been going to a race to the bottom and slashing prices for the EV industry, and that's created a disaster. Several EV companies have had to file for bankruptcy. Many others are losing billions of dollars on the bottom line, and it wouldn't surprise me if more companies go bankrupt. That's an industry I wanted to avoid and have avoided for the last 2 to 4 years, and that's been very beneficial because that industry has been a disaster. And so this is the opposite of that. This is the type of competition I like to see. So I like the prospects of the streaming industry going forward. The product that they offer is so much more convenient than the legacy way of consuming content. And so I expect overall demand to increase for content consumption. And that's going to be good news for Disney and Netflix. And then for Disney specifically, their theme park segment is absolutely thriving. They've been able to raise prices, increase income in that segment to go along with that streaming segment that's also thriving. Netflix is demonstrating what the operating margin potential is for streaming industry content. At 27% and rising, it's looking like a very attractive industry. Netflix mentioning in their most recent earnings call that their margins could continue expanding for the foreseeable future as the company adds these latest monetization capabilities. They started their ad-supported tier at a lower monthly price that's very, very favorable. Over half of their new subscribers are coming through the ad-supported tier. And then the password sharing crackdown is also working very well for Netflix and other industry participants. So they've got a very long runway where they can continue expanding margins. The Walt Disney Company, meanwhile, their streaming segment just recently turned profitable, and the theme parks are recovering from the devastations of the pandemic. And so their margin profile continues to improve as well at 14%. I wouldn't be surprised if Disney's operating margins surpass 25% over the next 3 years. The cash flow from operations to sales, similar story to the operating profit margin. The interesting way these companies account for content spending creates a bit of a difference between the operating income and cash flow. The good news is that for investors, the type of content that Netflix and Disney invest in is long lasting content. Movies and shows can stick around and generate views and subscriber growth for decades, right? Shows like Stranger Things and Squid Games can continue to entertain new subscribers for decades. And similarly with Disney, content like The Lion King and Avatar can entertain folks for decades. And so that's another positive for this industry is the money that's being spent on this content is very long lasting and could generate cash flow for decades. Returns on invested capital are excellent for Netflix at 23% and recovering for Disney at 3.7%. I wouldn't be surprised if Disney's return on invested capital surpasses 20% over the next 5 years or so as they as they continue to recover from the pandemic and as their streaming segment generates very strong profitability. So now let's look at valuation. Measuring by the forward price to earnings ratio, Netflix is almost twice as expensive at 32 and a half, while Disney trading at 17.8. When I look at my discounted cash flow models, I get a similar story with Netflix looking more expensive than Disney. My intrinsic value per share calculation at $826 for Netflix suggests that it's relatively fairly valued compared to the market price of $989, while my intrinsic value per share for Disney at $119 looks like it's undervalued compared to the current market price of $109. So while these are both excellent companies, if I had to pick just one of them to invest for the very long term, I would pick the Walt Disney Company today over Netflix. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.